Hi, I'm Jono, and today we're taking a closer look at trading 212.
In October 2025, the platform started selling crypto exchange-traded notes to retail investors in the United Kingdom without the authorization required by the financial regulator. 4 years earlier, the same platform had restricted buying on the most talked-about stocks in a generation, telling users it was protecting them from volatile market conditions. The platform that blocked users from buying volatile stocks to manage risk then sold them unauthorized crypto products without permission. In January 2026, the story broke in the financial press. No fine has been announced yet. The investigation is believed to be ongoing. The same platform has over 4.5 million funded accounts, a review score of 4.6 out of 5 from over 80,000 reviews, and a free tax-advantaged savings wrapper that none of its traditional competitors can match on cost. The product is excellent. The pattern is growth first, governance later. The platform was founded in Sophia, Bulgaria in 2004 under a different name by two developers who saw an opportunity in European retail trading. The original business was leveraged derivatives, contracts where the user bets on price direction without owning the underlying asset, and the platform takes the opposite side of the trade. When the user loses, the platform profits. The industry standard warning states that 75% of retail traders lose money on these products. That revenue funded the expansion into commission-free stock trading in 2016, tax-advantaged savings accounts in 2017, and fractional shares in 2018. The name was changed to include a New York area code as an aspirational nod to the financial capital the founders were trying to disrupt from Eastern Europe. The disruption in the United Kingdom was real. Traditional brokers were charging monthly fees and per-trade commissions that priced out younger investors entirely. The platform offered commission-free trading, a free tax-advantaged wrapper, and a mobile interface designed for people who had never used a brokerage before. The auto-invest feature that lets users build portfolios with automatic rebalancing became one of the most praised tools in the retail investing space. The charting integration added in 2025 gave the desktop platform professional-grade analysis. 4.5 million funded accounts by March 2026 made it the largest commission-free broker in the United Kingdom, and the reason traditional brokers started cutting their own fees. The tax-advantaged wrapper is the retention mechanism. Once a user transfers their investments into it, moving to a competitor requires a process that takes 30 days or more, during which the user cannot access the funds. The tax benefits are significant enough that most users will tolerate inconvenience rather than lose them. For a platform, every account inside that wrapper is a customer who is structurally difficult to lose. The commission-free label applies to stock and fund trades, but the platform generates revenue through mechanisms the marketing does not emphasize. Every trade involving a currency the user does not hold incurs a conversion fee that applies in both directions, meaning buying and later selling the same foreign stock triggers the charge twice. Deposits by card above a threshold carry a surcharge. The platform lends shares held in user accounts to short sellers, keeps the majority of the lending fee, and gives the user a smaller portion. Interest earned on the billions in client cash held across accounts is another revenue stream. The leveraged derivatives side charges a higher conversion rate than the stock trading side, adds overnight financing costs for positions held past the close, and uses wider spreads that represent additional cost the user absorbs without a separate line item. The regulatory environment prohibits the order routing model the platform's closest competitor in the United States relies on. European rules prevent brokers from accepting payments from market makers in exchange for directing trades to them. This means the platform cannot monetize order flow the way the competitor does, which is a structural advantage for users in terms of execution quality, but also explains why the leveraged derivatives business remains the primary revenue engine. The platform that markets itself as commission-free stocks for beginners makes most of its money from a product that 75% of its retail users lose money on. Both products exist in the same application with no meaningful visual separation. The account restriction pattern follows a similar shape to the competitor, but with lower amounts and a different regulatory backdrop. A 5-year customer reported in August 2025 that the platform suddenly prevented them from purchasing shares, citing a mismatch between their deposits and income on file. The platform framed the restriction as a regulatory obligation under consumer protection rules. the user escalated to the Financial Dispute Resolution Service. Multiple cases involving delayed transfers of the tax-advantaged wrapper have been formally investigated by that service, with documented failures including support agents who stopped replying mid-conversation and messaging systems where user messages disappeared. One transfer exceeded the 30-day timeframe the tax authority's own guidance recommends, with no communication from the platform during the delay. A clone operation using the platform's branding prompted a warning from the financial regulator in March 2025. Scammers had created an entity with a similar name and were soliciting deposits from retail investors who believed they were using the legitimate platform. Victims of the clone have no access to the compensation scheme that covers the real platform's users. The incident was not the platform's fault, but it exposed how the brand's visibility makes it a target for fraud. The platform's own outage tracking shows recurring access problems, with users reporting sign-in failures, server errors, and an obscure error code that locked at least one user out of their tax-advantaged account during market hours. There is no phone support to call when this happens. The 2021 trading restrictions during the retail investor surge remain in community memory, with users pointing out that the platform blocked buying on the same stocks on the same day as its largest competitor and blamed its executing broker for the margin requirements that triggered the halt. The restrictions were lifted within days. No lawsuits materialized in the way they did for the competitor, but the community remembers that when retail investors were winning for the first time, the platform removed the ability to continue buying while still allowing sales. The pattern of restricting access during moments of volatility and then offering unrestricted access to unauthorized product during calm periods is the contradiction the regulator has not yet reconciled. Trading 212 for anyone in the United Kingdom or Europe who wants commission-free access to stocks, funds, and a tax-advantaged savings wrapper that traditional brokers still charge monthly fees to provide, where fractional shares, automatic portfolio rebalancing, and professional charting tools make it the most complete free platform available, and where 4.5 million funded accounts and a 4.6 review score reflect a product that genuinely works for the majority of its users, accepting that the platform was founded on leveraged derivatives where it profits when retail users lose, that it sold crypto products to retail investors without the required regulatory authorization in 2025. That account restrictions triggered by income matching reviews have locked long-term users out of buying with slow escalation paths, that tax-advantaged wrapper transfers have exceeded regulatory timeframes with documented support failures, that the 2021 trading restrictions removed the ability to buy during the most volatile event in retail investing history, and that the commission-free label does not account for the currency conversion applied on every foreign trade, the card deposit surcharge, the share lending revenue the platform keeps, or the wider spreads and overnight costs on the derivatives side. The platform that disrupted a market built on high fees. Whether it replaced those fees or just redistributed them is the question the regulator has not finished answering. Every choice is a trade-off. At least now you know what you're trading.